Good day, fellow investors. Alibaba is a growth stock and I feel that it is a buy at the moment. In this video, we're going to discuss the business, the investing risk and rewards. We're going to go through our intrinsic value template and you're going to see what you can expect from investing in Alibaba now, and then you'll see whether it fits your portfolio or not. If you get value from this video, please click that like button and consider subscribing if you haven't. Let's start. Alright, given the recent news related to antitrust policies in China, Xi getting a little bit angry at Alibaba, we have seen a huge decline in the stock price. 256 was the close on Wednesday and we are now to $222. And if we look at this morning's action in Hong Kong, it opened at 2020 Hong Kong dollars, but then it continued to decline even after the lunch they have there. So we are going down, the sentiment is negative, and if we look at the long-term perspective here, 6 months, the peak was at 317 just 2 months ago, and we are now at 222. If they follow Hong Kong, even lower. This is a 30% decline for Alibaba. We have to keep in mind the market capitalization, $600 billion, which we'll use in the calculations. Long-term, the stock isn't far from where it was at the beginning of the year, so we could say from that perspective it's cheap. Longer term, since the IPO, the stock tripled, and that is actually in line with the growth that the company has delivered, revenues and free cash flows. And if the company keeps delivering on that growth, no matter the mambo-jumbo going on, the fight with Xi, antitrust, etc., then this will continue to perform so well because that's how growth stocks work. And let's discuss the business, the valuation, and you will see how it fits your portfolio. The most recent news were about Alibaba, especially Ant Group. It all started with the IPO that Xi closed down himself, and now the investigations are continuing. The company has been said to change certain things, so that's interesting, and it's really hurting the stock price as we have seen. However, it might also represent an opportunity. Of course, such big companies, the greatest companies of a country like China, are always going to be under scrutiny, so that's something they will live with forever and something that we have to take into account as a given. But there are also other things that might dissuade you from owning Alibaba, and we'll all discuss that, and then you will have a clear picture of what investing in Alibaba means. Let's start with the analysis of the business. To give an overview of what Alibaba is, revenue growth in the last quarter was 30%. 30%, that's very good. Cloud is growing even faster. The number of users is staggering, 800 million users, and the profitability is okay. 6 billion over the quarter are the free cash flows, and if they can keep that, that's already 24 billion over the year. And this growth and impacting the free cash flows, it is what will drive your investment returns. Revenue growth total was 34%. Core commerce, that is the largest part of Alibaba, is still growing. They're in line. New retail sales, huge growth there with all the new businesses they are launching. Cloud computing, 60% growth, and the logistics business, 50% growth. So still many growth strategies there. EBITDA is growing, free cash flow is growing, and I have looked at the free cash flows, 141 billion renminbi. When we divide that with US dollars is 20 billion over 2019. Let's say that the growth 20%, let's be conservative, we get to 25 billion in free cash flows over a year, and that's something we're going to use in our valuation and template later. 25 billion compared to a 600 billion market capitalization, which makes Alibaba cheap compared to Amazon. Amazon's market capitalization is 1.59 trillion. That's almost 3 times what Alibaba has, but we have calculated the cash flows in our template. Those are 34 billion. So cash flows are not even 40% higher. The market cap is almost 3 times higher on slower current growth. So from that perspective, compared to Amazon, Alibaba is really cheap. Plus, the Chinese economy is expected to be as big as the US economy in the coming decades, so plenty of growth and potential there, even more than what Amazon might have. And this is what we are talking about. If Alibaba manages to engage more with the customers, scale the 800 million users they have, sell more, sell whatever they can do, then add the finance part, then if they quadruple just on the revenues, just on the existing customer, as they expect, from 30 purchases per year to 93 purchases per year, then the growth will be there and the stock will do greatly. They're investing for future growth. You see a lot of businesses, from smaller businesses like small trees and seeds, things that are in traction, and things that are really great and profitable. Plus, they are really scaling into everything and tapping into new sectors. And you can see here the discussion with electric vehicles. Electric vehicles, profitable, companies with great scale, moats, in power, knowledge power, and everything, and they are tapping into those businesses. So when a business is profitable, which is also a risk that can backfire for Alibaba, when a business is profitable, everybody is going into that business. So those growth projections are really difficult to estimate, because you never know what will the growth be, and then what will be the competition in the sector and the consequent profitability. That's one of the things to keep in mind when investing in growth stocks. Long term, it's not all about the growth. However, Alibaba is really well positioned with all the enterprises that they are doing and scaling for long-term growth and long-term positioning, not only in the Chinese economy but also globally. And yes, revenue growth was 34% in 2019. Now it's declined a little bit, and given the scale, it will likely continue to decline. And that's something you have to know when it comes to growth stocks, because the growth rate will determine your long-term return. And we have to take the growth estimations with a margin of safety to see, okay, when a growth stock can be a value stock and bought with a margin of safety, like we bought, I don't know, Facebook a year, 2 years ago. Because at one point the growth will certainly stop, and then you have this. So Microsoft stock was lingering around $30 for 13 years. That's a long period of nothing, where most of the investors capitulated, and that's something you have to keep in mind as a risk. Alibaba is not going to disappear. Alibaba is going to be there in 10-20 years. But the importance is to understand when you are buying it, and I think it's still early, especially compared to Amazon and the potential that Asia offers. So I don't think this is a chance. We might see prior exuberance and then see this, but it's a risk that you have to take into account, among other risks that we'll discuss in the risk section. So let's go through our template. If you want to download it, there are also other stocks here that we have analyzed. You can play around with the numbers. If you want to download this, just type in Google Sven Carlin research platform, and you go here, Sven Carlin research platform teachable. If you want to look what I do, more stock analysis, this is what I do professionally, check my platform. If you just want the template, it's under the free stock market investing course, so you can enroll to be notified when there is a new lecture in the curriculum. But if you just want to download, you go to how to calculate intrinsic value formula, and here you have the updated Excel file. And if you want to learn more or enjoy other videos and written concepts, please have fun. Let's make the Alibaba analysis. So This is Amazon. Sorry, I go to Alibaba, and we said cash flows 2020, let's say 24 billion. Now we have to change the growth rates. We are now 30%, let's say 25% over the next 5 years, and then 15% up to 2030, discount rate 10, and now we have to determine a terminal multiple for 2030. What will the market price Alibaba in 10 years? Impossible to know. So the more conservative we are, the better. If the company is still growing at 10% and has good cash flows, let's say that the terminal multiple in a conservative scenario is 20, which would mean that Alibaba with such growth rates would make 147 billion in free cash flows in 2030. That's really a lot. That's 5-6 times what it's making now, and the market cap would be 2.5 trillion. So in line, let's say, with what Amazon could be in 10 years. The intrinsic value, the value then would then be 4 times your money. So you would make, in a normal case scenario for Alibaba, in 10 years 4 times your money. I think that's something great, but let's be more conservative with the growth rates to be more sure about the investment, because anything can happen, as we have seen over the last months with Alibaba. Let's go to the worst case scenario. We said 24 billion, and then okay, growth in the next 5 years, let's say just 15% on the cash flows, and then 10% terminal multiple, let's take 15, it's China. 1 billion market cap over the next 10 years, so you would still make money, what's that, about 80% over 10 years, so a good return, let's say in the worst case scenario. Best case scenario, okay, let's say they keep growing at 25% and then they slow down to 20%, multiple in the future, let's say 30. Really a little bit of exuberance, forgot the cash flows, 24. Then the terminal value, if they grow so fast, would be 4.5 trillion. So that's what, an 8-bagger over 10 years. If they don't pay dividends, let's say they just focus on growth, so you get the intrinsic value now 30% undervalued in a base case scenario, a lot undervalued in the best case scenario, and of course a little bit overvalued in the worst case scenario. But this is, let's say, the margin of safety. This is the likely outlook, so a likely return, a 3-bagger, 4-bagger, perhaps a little bit too exuberant, because this is my concern. Will they be able to make $140 trillion in 2030? So I would say that's really a lot in the global perspective of money. Let's be even more conservative. Let's say the revenue grows, but the cash flows grow slowly into new businesses. Let's say that we have a growth rate really of 15%, and then let's say 8%, and let's say that in 2030 they make 70 billion of free cash flows. Of those 70 billion, let's say they pay half of that into the dividend. Terminal multiple is, let's say, 15, and we are still at 1 billion. So you still make money with Alibaba. Of course, it will all depend on the growth here, but long term, if they keep growing at these rates, the market will price the growth in. And exactly as it did over the last few years, if they keep growing at 30%, then your returns over the next few years will be 30%. But you must keep in mind that at some point the growth will stop, because we're pricing it as a growth stock, growth. Then when it transitions from huge growth to slower growth, then it might take years for it to catch up again. This is growth stock transitioning into a stalwart, slower growth stock, and then it can expand again on other things. So you have to see how it fits you. This is from a growth stock investing perspective. And feel free to download this and play around. The link is always with other links in the description below. But when it comes to investing in any stocks, there are also other risks that you have to consider, uncertainties, and you have to see how it fits your portfolio. We have seen the political environment from Alibaba. Jack Ma isn't loved by Xi, so status power there fight, and which means it's highly uncertain. It's yes cheap in comparison to Amazon, and it also shows what might happen to Amazon because there are also a lot of antitrust probes there, and there is the VIE structure when it comes to Alibaba, where you are not the owner, you just have a contract with the entity in China. If you look at Alibaba's annual report, it has almost 500 pages, so that's really a lot compared to other annual reports, which means they have a lot of things to say. The most important thing is this is a variable interest entity, so you own the entity on Cayman Islands, which is offshore outside China, owns other entities, and these entities owned by the Cayman Island entity have a contract with the entities in China. So contractual agreements, and that is also a risk, because if China decides that these contractual agreements are illegal, then it would get really, really ugly. However, on the other hand, if China decides that it would be a world clash, we would have other fish to fry. So it might make you a little bit uncertain, but it is a risk. However, we have to price that risk in comparison to other stocks, and I don't think that it's really a position to be so much cheaper than Amazon because of this. We'll see how Amazon evolves, so it's always a risk and reward, good to keep in mind, and you might enjoy the pages and pages on the annual report if you want to read more about that. Another risks are, of course, what we discussed in the intrinsic value part, the cash flows here. 24 billion is okay, it's a good position in the market, but if the growth rate is faster, 182 billion is really a lot of money, and few companies, even Apple has plateaued at 60 billion. So at some point they will plateau, and at what point will they plateau? That will be the turn from a growth into a stalwart stock, and that might not look great on your investment return. So as long as it is a growth stock, you have to think about it also balancing your position in relation to your portfolio. On the positive side, it certainly has a moat, it's cheap for sure, it's a buy. If they keep growing, it will go higher and higher no matter the current situation. When to buy is another question. Now, I have received a lot of comments here because the stock dropped, but the stock is where it was just 6 months ago, and it's a growth stock. And let's take another look at Amazon. Would it made a big difference for you if you bought at 400 or at 300? You would have made, okay, 7 times your money and 10 times your money. Would it be a great difference when it comes to investing? So the same with Alibaba. You are buying a growth stock. Does it really matter if it becomes a 2 trillion company, whether you bought at 600 billion or at 500 billion, whether you bought at 300 or at 200? Of course it's better, but 5 times your money, 10 times your money, at the end you make money, and that's the key investment structure here. So I think it can go lower if there is more shaky hands, a lot of retail investors gambling in the market, focusing on that growth. Okay, this is going grow. When they start selling and nobody's buying, because why would I buy if it's going lower, then it can get really ugly. But at some point you have to see, okay, at what rate am I certain that this fits well my long-term investing profile, and that's how we long-term investors make money. I'm going to follow Alibaba over the week, maybe reinstate the coverage, add it to my large portfolio because it feels like a buy, but that's something I'll research more over the week. Thank you for watching. Please consider subscribing, don't forget to click the like button, and I'll see you in the next video.